Welcome to Non-Beta Alpha, your source for unique insights into current market trends with host Ryan Morfin, CEO of Wentworth Management Services. Today we're discussing expectations for the go-forward fiscal policy and what the new normal for taxes might look like. We're joined by our guest, Thomas Handler, partner at Handler Thayer LLP, a law firm dedicated to rendering superior, technologically current, and innovative professional services to affluent families, family offices, and private-held companies. This show is brought to you by StatusJet. Elevate your status.
Tom, welcome to the show. Thank you for joining us.
It's a pleasure to be here. Thanks for having me.
So, Tom, you advise some of the largest family offices in the country. You help them with their estate, their tax, their legal issues. Given that we're in a new environment politically, and from a long-term perspective, we've never spent this much money from our government this quickly. With people who've amassed wealth, what should they expect in terms of the go-forward, in terms of fiscal policy for this country, and what should they be doing to prepare themselves for maybe a new normal as it relates to taxes?
Sure. I think that there are a lot of complex factors that weigh in on the inescapable conclusion that increasingly our politicians are more willing to mortgage the futures of our great-grandchildren and great-great-grandchildren. The expected deficit in the next 3 years is $8 trillion. The current deficit is $27 trillion. So it took hundreds of years to rack up $27 trillion, but we got to come up with 8. And on the state and local level, they're in the same boat. So states that had reserves no longer have reserves. States that were in trouble are now in deep trouble. And so every organization is clamoring for tax revenue. And the proposals that are on the table are a reflection of what's going on in society. So in effect, as the Democratic Party continues leaning farther and farther left, becomes perfectly acceptable to almost take money, not an unconstitutional deprivation of property without due process, which really hasn't happened since Obama took the stock from the General Motors and Chrysler shareholders. And I'm shocked that it wasn't met with far more furor and hostility than it was, but he got away with it and it was totally inappropriate. So the world believes this is the least likely country to misappropriate assets or nationalize companies. For that reason, the money is flying here. That's not solving our deficit problem. So the inescapable conclusion is that the vast majority of these tax hikes, in the ones currently proposed by the Biden administration and the Democratic Party, as well as what the future looks like, regardless of how the political winds change, they need a tremendous amount of revenue to store up these coffers because there's been virtually no cuts in government. They're not firing anybody. They're not getting rid of agencies. It just continues to grow and grow and grow out of control. And they didn't miss a meal. They didn't get laid off. So the many people that suffered under COVID, for the most part, government didn't suffer at all. So this need for revenue is going to fall squarely on the top of the heads of the top 1%, and next on the top 10%, and then on future generations with the debt being piled up. So for example, if you quantify the current Biden proposals, the average American will suffer a 2% loss in income after tax as a result of these provisions. So it's not true it's only going to hit the high end, it's going to hit everybody, but the high end gets particularly hard hit. And the cutoff Biden establishes about 400,000. So everyone over 400,000 is going to get slaughtered, and the average top 1% to 2% person will lose 8 to 10% of their income after tax. So this will represent one of the most gargantuan tax hikes in history because it's a combination of income tax, capital gains tax, Social Security tax, and the estate and gift tax. And those changes are massive, which will be felt more down the road, but very, very substantial. So I've never seen an environment even close to this in my entire career. This is truly extraordinary. And the grab for money is going to be like nothing we've ever seen before.
Well, and that leads us to, a pause, if you will, this great pause of this pandemic that's caused people to shift gears. How are family offices and ultra high net worth families reacting Is it a rebalancing approach of how they invest maybe into the markets versus private equity? Are they doing a lot more tax structuring from estate planning? What have you seen through the last 12 months?
Sure. So in the markets, families are becoming much more concerned about tax harvesting. And in view of the capital gain proposals, which put the new tax at 43.4%, it's a gargantuan tax for anybody with over $1 million in income. At 43.4, you can rest assured people are going to plan for it. So there are some very technical proprietary strategies that will help ameliorate that issue. People will smooth out capital gains, try to take them systematically instead of waiting and pushing them down the road. They'll try to take them in years when their income is lower and it won't all contribute in one year to blow them over the limitation into the higher tax rates. So you're going to see a lot of massaging going on. And in view of the very substantial tax hikes on the table, families are working overtime on their tax planning, their estate planning, their asset protection planning. So in particular, literally since the Georgia Senate election, our phone has been ringing off the hook. And January and February are typically slow months, and we can't keep up. It's just a feeding frenzy out there. And the family offices primarily are looking first and foremost at structure and restructure to try to pick up as many estate tax and income tax benefits as they possibly can, as well as corporate benefits, because the Biden proposal will jack up the rate precipitously on business income as well. And fewer entities will qualify as qualified businesses eligible for the lower rates. So people are planning around that. And the estate planning is going wild because if the exclusion amount goes from 11.7 million down to 3 or 3.5 million, that's that's just a gargantuan increase in estate taxes. And further, the rate is proposed to go up to 45%. So 45% on the estate tax, 45% on the generation skipping tax, plus the state estate and inheritance taxes, which tend to be in the 10 to 16% range for the most part. Some states have both an inheritance tax and an estate tax that come into the law when they're bankrupt. So look for those, look for the rates to go up and the exclusions to go down. And if the federal exclusion goes down, the states will follow. So they've got a current $3 million exemption and the feds go down to 3.5. You can watch that drop to $1 million, which is kind of where it was in the past. And then a provision that isn't getting much press is a proposal to also knock the gift tax exclusion down to $1 million. So in the past, we had a system where they were not aligned. It wasn't a unified system. Now they are. The same tax applies at gift or at death. The same exclusion applies to both. Well, the proposal is that the gift exclusion will drop to 1. So you'll be taxed much higher on gifts than you will on deathbed gifts called bequests. So they'll change up that situation as well. So the structure of planning that's really a frenzy right now. And by frenzy, I mean, we were hired for 5 of these engagements in the last 4 days. And the idea is that the family office structure, in order to maximize estate discounts and transfers and to function in a comprehensive manner, and to pick up the income tax benefits that got blown out by the TCJA, and those are largely legal, accounting, and investment advisory fees, all of us professionals, individuals can no longer deduct those expenses. So in the past, they were difficult to get as your income went up because they were subject to AGI limitations and phase outs, and a Pease amendment was in place. Well, that Pease amendment is looking to come back, which knocks another 3% off the top. The AGI limitation is still there, but then the extra piece is that the Biden proposal is to limit the value of itemized deductions to 25%. So even if we're in a roughly 40% tax bracket, you'll only get a 25% deduction for everything on Schedule A: medical expenses, charitable expenses, taxes, interest, and then employee business expenses. So it would blow out all those legal, tax, accounting, and investment expenses: investment advisory, investment management, investment research, investment seminars, investment newspapers, investment magazines. They're all gone. And they're supposed to sunset in 2025 and come back on January 1 of 2026. Few practitioners believe they're ever going to come back. And if they come back, most of our client base will not be able to get them anyway. So they're gone. So the only way to get them is in a properly structured family office. So a lot of the work is driven in that direction. At the same time, people are looking for ways to push out the earnings so they don't get hit with these very onerous capital gains and these onerous rates. They're looking at alternatives and holding on to their stock portfolios for a longer period of time, less machinations in the portfolios specifically for that purpose. The allocation right now to alternatives among family offices is approximately 35%. Approximately 15% of that is in private equity. Approximately 15% of it is in real estate. So those are two of the biggest sectors, and the rest are split around. The allocations to hedge funds tend to be dropping, while the allocation to real estate and private equity are going up. Those studies, I think, though, represent traditional larger family office. I think a lot of the virtual family office and the smaller offices that have 50 to 200 million are not in that set. So I don't think they're as heavily into private equity and real estate as the larger offices, but it's still a significant portion of their portfolio. So these allocations and the future investments will focus on little longer term holding periods specifically to get the benefit of that pushing off the capital gain. On the other hand, with interest rates so painfully low and inflation quite likely over the next few years, nobody wants to go long on cash or cash equivalents because the premium is non-existent and it's just not worth it. So everyone's staying fairly short term and waiting for rates to pop up, which they almost certainly will have to do at some point.
Yeah, Tom, the term family office has a lot of connotations and definitions. From your perspective, how do you define a family office?
A family office is an organized business enterprise set up to run the long-term wealth management affairs of a proprietary family. Pure and simple. It's just another family business, but it's very focused. The SEC defines it as an enterprise for the family that handles their investments, tax planning, estate planning, and other critical services. There's about 35 things that a family office could do. The industry sort of defined all these potential things, but the industry will say if you do a dozen of them, they'll recognize you as a real multifamily office as opposed to a purely investment shop. Calls itself a multifamily office, but doesn't get involved in asset protection or premarital planning or taxes or estate planning or reporting or anything else. So that business enterprise then can be a multifamily office, which typically is two or more families together. And usually those start at about $1 billion in AUM and often larger than that. You have a couple families come together, so they're often 2 to 3 billion as they get warmed up. The virtual family office could be as low as 25 million to there are virtual family offices with billions of dollars of AUM. And then the single family office typically will start around 100 million. Most of them are in the 250 to $600 million range. And of course it goes up to the sky's the limit. And there's been a proliferation of all of those. So 20 years ago, there were perhaps 40 multifamily offices in North America. Now there's about 140, and they've been the most magnetic source of capital. In other words, they've garnered more investment dollars than outsourced CIOs, trust companies, banks, wirehouses, investment firms. They've been very attractive in large measure because the families perceive them to be on their side. So they have an advisor, a champion, so to speak. The interesting thing, I think, is that although virtual family offices have been proliferating, mostly in North America, they're going to shoot through the roof, almost like the old days, in large measure, because if these lifetime exclusion amounts go down to the amounts we're talking about, 3 to 3.5 million for the federal estate tax and $1 million for the gift tax, and then the rates go up. In the past, family limited partnerships, which were the first type of family holding company, been around for 100 years, and they were the mainstay. And for a time, anybody with $2 million would consider putting those in place. Now, inflated, maybe that's $10 million today. But when the exclusions go down, if the state exclusions are $500,000 or $1 million, people are still going to be motivated to do this because the discounts are very high. So the portfolio discounts run really from 15 to 77%. That's the range that I've seen in practice. Most of the valuations come back between 25 and 45%. In our experience, our last three examinations, the net result was over a 35% discount, two of them no change letters, and the original valuations came in the high 30s. And this was on audit. This was without going to a supervisory conference, an appellate conferee, or to tax court or district court. This is what they gave us out of the block. So the IRS handbook says specifically to challenge all discounts over 25%. But the reality is, if it's a well-executed structure and you've crossed the T's and dotted the I's, they don't want to fight that fight. That's a losing battle. It's going to cost them too much time and money, and they're not going to win. So they're going after the low-hanging fruit. So sloppy family holding companies that were not well put together, or deathbed gifts or commingled funds, those are all targets and they're going to be had. But the reality is the number's quite a bit higher for the families that have got it buttoned up. So just like the old days, when those exclusions go down for a married couple at 7 million, the family holding company will pay for itself in short order with just the estate tax discounts. And if your state has a $500,000 or $1 million exclusion, it kicks in even faster. So what that does is it lowers the bar, and the structure becomes much more cost effective at much lower thresholds. So if these laws go through, you're going to see these things blister, almost like it was, in the 80s and 90s when these things were just omnipresent. It'll be back to that old situation. The difference now is that those individual deductions, the legal, the accounting, and the investment expenses that you can't deduct, they can be deducted in this family office. So now you've got a big income tax benefit on top of the estate tax benefit, which will make them even more compelling. So I think the opportunity for people like you and I is that investment advisors, if the client's got a virtual family office or family office, they're getting a 40% discount or more, depending on what state they're in. In California, could be in the 50 some percent, very high discounts off of our fees, your fees. And so it's a pretty compelling structure for that reason. But the reason to do it is the asset protection, the premarital planning, and the estate discounting, which is compelling. But they need to be done at a high level. They need to be well integrated. The structure's got to be correct, or it won't accomplish this objective. The vast majority of firms that set these things up don't understand asset protection, put them in the wrong places. There's really only 2 states and about 13 foreign countries to park these things in. If you want a high level asset protection, people throw them all over the place, and it's not as effective as it could be. So doing this at a high level is much more effective than doing these at a commonplace level. But even a poorly done family limited partnership, family LLC, or family series LLC, even a poorly executed one is still pretty compelling. It'll create some good. It'll help families, even if it's not well done. If it's well done, it's a game changer.
So a lot of the people who watch this show are financial advisors or ultra high net worth folks that maybe recently looked to sell their business or will be selling their business. If you have somebody who's going to have a liquidity event for a few $100 million, what should they be thinking about as they enter that sale and that purchase and sale contract? How would you advise them to start getting their ducks in a row to kind of give birth to a family office for their heirs?
Sure. Well, we have 2 of those precise engagements right now, and we just got hired for another one where the exit is not firmed up, but it's expected sometime in 2021. They don't know, end of the year maybe, or early 22 at the latest. I'm guessing that 90% of all business owners who have a major exit, a merger, IPO, whatever it's going to be, sale, don't have time to do pre-exit planning, and they don't do it. They're not advised to do it typically, and they kind of skip it. And that's a mistake. And to highlight it, my favorite story is a neighbor, a guy from Winnetka, Illinois, and another neighbor referred to him and said, you're selling your company for a few $100 million, you better talk to this guy. So I talked to him, I said, look, I got plenty of work to do, but we can make a big difference. If you let me do some pre-exit planning, I think we can save you a lot of money on both estate and income tax. And the client said, I'm dealing with the road show. I'm still running the company. I just have no time. I just can't do it. He goes, but the minute we're done, set up the family office, kick up the estate plan a notch. I want some asset protection, look at my income taxes, do the whole shot. We said, okay, we understand. If you can't get it, but I guarantee you leave money on the table. So the transaction was supposed to close in December. We talked to him in October, and he called up in late December and said, it hasn't closed yet, but I have a question. Should I consider moving the trust? Because I've transferred, a lot of the money to my children. They own chunks of the company, and there's 3 trusts. Should I do something with those trusts? I said, well, I don't really know. He said, well, I talked to our biggest law firm in their state, big nationwide law firm, and they said, no, I wouldn't bother. It's not worth it. It's just a small deal. Doesn't make any sense to us. So we said, if you give us a budget, give us a $15,000 budget, we can figure it out, and I can tell you whether you should move it and quantify it for you. This guy was a Harvard MBA. He understood numbers. He wanted to know whether it made sense. So we did the analysis. Approximately $13,000. We figured it out and moved all the trusts. As it turned out, none of the children were in that state. None of the trustees were in that state. None of the assets were in that state. The only thing in that state was the big lazy law firm that didn't know anybody's law but their own state. They didn't bother to look at any place else where you could park these things. So in the process of moving them, we ended up saving approximately $32 million. It was a gargantuan savings. And then the annual savings going forward were massive because we moved it to a state that doesn't have an income tax. So you could be paying 5 to 12% depending on what state you're in. So that pre-exit plan is pretty critical. And you want to do some estate transfers with a structure in place. So if you can, you put in the virtual family office structure ahead of time, put the assets in those family holding companies, and do sales and investment banking transactions among family members and trusts to get some of it out before you're stuck with the closing value. So as you're every day closer to the exit, the value becomes more fixed. So you've got a private company value. Now you're talking to valuation firms. You have more data that changes the value. Now you've got offers, good or bad, contingent, that changes the value. Now you sign a deal, you've got one number, then they go through due diligence, now you've got another number, and then once you close, you're at full value. So any step you get before that exit will give you an intrinsic discount, and then layer what I'm guessing will be a 35% family holding company discount on top of that. Maybe we can transfer 40% of that company with zero estate or gift tax cost. That's a gargantuan step in the right direction. Then, of course, you all have all the income tax that goes with it. I'm going to guess that maybe a quarter of the people that we've advised will make that a priority and actually do it. The vast majority wait until after the exit, and that's a mistake. There's a lot that we can do. And we can significantly enhance the asset protection and premarital planning before the exit as well when it's easier to do.
And I believe it's the case, but Dodd-Frank has made it that if you've got a family office of a certain size or dollar amount or several generations, you need to be registered as an RIA. Is that correct?
Well, there are requirements. And so the Dodd-Frank changed the long-term family office exemption. And the exemption is different now, but one of the keys is that you can only invest for family members. And the exception is in-laws, so people who marry in, and if they get divorced, they get to stay in until their investment. And then executives in the family office, the CEO, the general counsel, the CIO, they can invest along with the family, but the rank and file, the secretaries can't, which kind of makes no sense to me, but that's what they did. Where the issue of registration comes in is either an RIA or a broker dealer. Is one, the minute you have a non-family member, you're required to register, at least as an RIA, potentially as a broker dealer. And of course, these people have no experience with that. They don't have compliance officers. They don't really realize what FINRA, SEC, and CFTC audits are all about. And it's a wake-up call when they discover that. So they work pretty hard to avoid that. The bigger issue tends to be with current trends, and there's 2 places where the issue comes from. One is pooled investments and direct investments. When you're the family that originates a deal, even if everybody else combines into the deal and you run it, you run the risk of tying your family office into managing money for other people, which would blow the exemption and require registration. They also tend not to do full PPMs. So even though these people are sophisticated investors, there's some securities risk because often they're parking money in trusts that aren't aren't accredited investors. They're not paying attention. The family's accredited, but this trust just got started for the great grandkids. It's not yet accredited. You can't just throw it in with the family. It doesn't work that way. So that's an issue on one hand. The other place this comes from are the real estate families who are notorious from doing deals with each other. And what happens, they do syndications. One person runs the deal. And in the viewpoint of the SEC, many of them should be broker dealers or RIAs or both, and very, very few are. So I think the level of non-compliance among real estate families is quite high, and they're definitely at risk. So in the future, the SEC historically has not made much of an issue of this, but times are changing. So along with this incredible tax hike really being dumped on the top 1%, the same mindset permeates the government and judges and juries and the media, social media, newspapers. They're vilifying wealth, vilifying education, and vilifying affluence. Like somebody dropped a pot of gold in your backyard, so they deserve to have it. It's kind of the communist theory. You got it. Why can't you share it with me? What's your problem? And so this extreme socialism hasn't been effective in any country bigger than Rhode Island, where everyone's related to each other. They're trying to apply it on a national scale. I've been to Iceland. It's lovely, but it doesn't translate, on a nationwide basis. And so you've got this incredible entitled population. We have half the population supporting the other half. Half of the US population is either on welfare or works for the government. The 4 biggest employers in Illinois, for example, are all governments. Crook County is the 14th largest government in the United States. It's a county. It's insane. So we are the highest overall taxing state, and we're the most bankrupt state. And that inverse correlation should never exist. So going forward, families are at risk because they're being vilified. And if you saw the race riots and all the things that are going on, people beat up, pushed, cars firebombed, stores destroyed, restaurants bombed, people beat up for no particular reason. It's insanity. It's so upside down right now. And there's lawlessness being tolerated by these big city mayors who are grossly incompetent. Their towns are completely over budget and in deep deficits, and they issue stand-down orders. And then more law-abiding citizens get killed, beaten, robbed, mugged, raped, you name it. It's insane out there. This environment is so upside down, I don't even understand what's going on. But that permeates the government and the media. So your clients, the top 10%, they are targets, and they're feeling like targets, and they're running for cover. You're going to see all kinds.
Well, let's talk about that for a second. I mean, you're living in Illinois, right? It's a bankrupt state, as you mentioned. I tend to agree with you.
How do you think the politicians can continue to get away with, for anything else? Let's just focus on the pension liabilities, the healthcare liabilities that they're not accounting for properly. How is it that the media, the pensioners, Department of Labor, how are these people not paying attention to the fact that there's billions and billions of dollars of healthcare liabilities that aren't being accounted for on their balance sheets? I mean, if any company did that, public company, the entire management team would be thrown in jail. How can they get away with this?
Well, the honest answers are that the government's not very good at most things. The people that work there are far less capable than the private sector. They work fewer hours. They are less credentialed. So 50 years ago, the private sector made almost 3 times as much as their counterparts in the government sector. Now that's flipped. The government sector literally makes almost twice as much as their private sector counterpart. And they do that with fewer qualifications, working fewer hours, having more vacations and holidays than I'll ever get in my life, an incredibly generous pension, and they work a short day. They work a 6-hour day. I've had IRS people at my office saying, can we stay here and drink your cappuccino and watch your TV for an hour or so? It's 3:30. It's really not worth going back to the office. Of course, I'm thinking to myself, your office is 6 blocks away. You can work until 7 like we do. Get your butt out of here and go back to your office. But instead, you smile and say, hey, let me get you a cup of coffee because they're auditing my client. I don't want my client to have a hard time. So you put up with the nonsense. So the reality is the incompetence is overwhelming. Whenever you start an election, half the election works for the government or is entitled. So 90% of that votes in the bag if they vote. So you're only fighting over the remaining half. So to not elect the entitled parties, whoever gives away the most stuff, you've got to have a supermajority of the remaining people. And that's very difficult to do. And they ignore it because, frankly, the media, the journalists, I won't pick on any particular publication, but some of the highest end, most sophisticated financial publications in this country, I've been quoted in almost all of them. I've been misquoted in almost all of them. They get the facts wrong. They're writing articles on things they don't know what they're talking about. I said, if you write that article, you're going to embarrass yourself. You're going to look stupid. You shouldn't do that. And it's some 25-year-old author who was a journalism major or a rep major, and they're very bright and talented. They can't count to 5 without their fingers. They have no finance, statistics, economics background, and they're writing on tax and economic and finance issues in the most prestigious financial and business publications in the country. And they have no experience. They have no way to understand this. And I've changed an embarrassing story into the correct story. And I said, look, here's 3 other lawyers. Call them. You're off. You're just way off the mark. But if you don't have that kind of background, if you don't understand taxes and accounting and economics and finance, you have a really hard time figuring out what's going on. And that's the media. And the social media is far worse. This current level of censorship that's going on is unconstitutional and inexcusable. And I hope they get sued left and right to Sunday, because you had 35 leaders of foreign countries who hate Trump, who criticized our social media for censoring him. What does that tell you? I mean, come on. It's so far over the top. It's rather ludicrous. I actually canceled subscription to the Chicago Tribune, which I've been reading since I was in high school, because I'm tired of reading leftist, inaccurate tripe. It's not balanced. It's not correct. It's largely incompetent. I'm like, this just isn't worth my time. Why am I bothering to read this?
Tom, that's why we started this show, so we could try to get people like you and others who just speak truth, at least a data point to our viewers. The question for you is, so you've got all these people of affluence who have targets on their back. They're living in some of America's best cities on the coasts, but they're getting tired of being vilified by these politicians, and they're moving to other, we'll call it business-friendlier states. What have you seen in Illinois? I mean, are people leaving? Is the wealth transferring to other states? Are businesses moving? What are you seeing, on the front lines of this trend?
So this is one of the most interesting areas to me because it's such a great commentary on human nature. And my conclusion, I was a psych minor, which qualifies me to know enough to be dangerous and nothing more. But I was a real student of personality theory. And I read not all the textbooks, but every cited book in those books. It was just such a fascinating area. Of course, there are no jobs in psychology. When I came out, 1 out of 26 psychology majors actually got a job. So I very quickly changed into accounting, where everybody got a job. But there's a global phenomenon of taxpayer flight, and it's been going on for quite some time. And it's getting exacerbated because of the current conditions. So people don't want to be told that their beliefs are nonsense and their traditional values are inappropriate, and you don't need to be married. You can have baby mamas. It's all good. What's your problem? And then be criticized for it. I mean, that's ludicrous. So that emotional piece drives people. The financial piece drives people more. So Illinois had 2 seminars for the bar on this subject in the last 10 years. I gave them both. I have all the data, where people went, how they do it, where they go, why they go. Number 1 reason, taxation. Number 2 reason, debt. Number 3 reason, corruption. Number 4 reason, it isn't going to change. So people flying out of places like, New Jersey, New York, Illinois, those are the reasons. In most other states, the corruption is not quite as bad as in those states. New Jersey and Illinois are 2 of the top 3, by the way, and have been for quite some time. Mostly because the cities, not the state. It's the city of Chicago. It's the big cities that are the problem. People are leaving countries for their high taxation. So when the wealth tax got put in a number of countries in Europe, it basically, people left in droves. Billionaires left, 100-millionaire people. People moved their businesses. I don't need this. So it caused massive departure from the country, loss in tax revenue, and drops in GDP. So it was very unsuccessful. And the problem is that with a wealth tax, just like our real estate taxes, that's the only wealth tax we have right now. But that is a wealth tax. You get to keep paying for your home over and over again, even though you already own it, because the government said, you got a $2 million home. We think your taxes are $50,000 a year. Just write us $50,000. And the federal regime changed it. Now you can't deduct it. So you get to pay for your home several times over before you die. It's a lovely proposition, but that's a wealth tax. And when people cite the income tax, they're like, well, everyone's paying 5%. Like, well, no, they're not, because none of these people own homes. So the massive taxes, the real estate tax, the wealth tax, the income tax is irrelevant, compared to what I'm paying in property taxes. And most people in high tax states, Connecticut, Minnesota, Massachusetts, New Jersey, New York, Illinois, California, just part of the deal. So people are leaving states, provinces, and countries for the same reason. And they tend to go to more conservative jurisdictions who have a balanced budget or surplus, a lower tax regime, better asset protection, and they tend to be less blue states for the most part in the U.S. For countries, people are looking for high caliber countries with a lot of freedom. A favorite place is New Zealand. It's been rated one of the most free countries in the world, and people are attracted to that. They don't like this attack on fundamental constitutional freedoms that we've been enduring. And in places like Chicago, with these incredible Black Lives Matter race riots and destruction, billions of dollars of destruction, restaurants, everything's still boarded up. It's insane. It's months later. My clients won't go downtown. They do not want to come downtown to visit. They're afraid to come into town, and they should be afraid. I don't stay down after dark. I drive home. I don't need this. People are getting carjacked and beaten up all day long. Carjackings were double in 2020, and they're way up this year, even from 2020's ridiculous level. I'm like, you gotta be kidding. We're the police. Oh, to make it better, Illinois just passed a law. The police no longer have tort immunity. So every police group in every state, every county are immune from personal lawsuits, because then they're afraid to act. One act, they end up in a lawsuit, spend $500,000, they lose their house and their car. They're now personally liable, which will chill any kind of action. The good police will leave the state in droves, and they're not going to do their jobs, which just puts honest citizens at risk. So in Illinois, people are flying out of the state. We are the number one per capita place people have left. And by the time the people leave, they've already moved their companies. So if it's a big company, they invert it, to Europe or some other place. That's a move to a foreign country. If it's a local business, smaller business, they'll just move over the border to another state. Then they move their family holding companies out of here if they made the mistake of putting them here in the first place. Then they move them like they should have done in the front end. They move the trusts out of here. And then the last thing to go are the people. So by the time you see the data that the people are flying out of here at the rate of 350 a day, that means everything else, the capital's already moved, the business has already moved, jobs have left the state, and it's inescapable. But I keep reading in the media that it's not really happening. It's not because of taxes. It's just coincidence. I'm like, delusional nonsense. People are more Pavlovian than Pavlov's dog. Taxes go up, people leave. Deficit goes up, people leave. People feel at risk. They can't be safe. I've never felt unsafe in this state in my entire life until this last year, largely because we have a grossly incompetent mayor that put in stand down orders. How do you tell the police to stand and watch people getting assaulted and beaten up? Both my son and nephew were nearly beaten to death, 5 days in the hospital for no reason other than they were young white guys in downtown Chicago in the wrong place at the wrong time. They didn't do anything. They could have been killed. We're lucky they didn't get hurt further. And this is going on in all the major cities. People won't go out at night in New York either for the same reason. It's just a sad commentary. So layer that on top of these taxes and the fact that our politicians and media and the unions in particular, the government unions, because the unions hardly exist in the private sector, but they're all over the governments. And that was a mistake. Most countries forbid government officials from unionizing. And I love John Kennedy, who, by the way, is more conservative than Trump, but he made a mistake and allowed government employees to unionize, and we've been paying for it ever since. And that's how Illinois' massive deficit got built up, by these unions who basically will elect anybody who will give them the most stuff. It's painful and it's tragic.
So let's talk about these special situations where people are flying across borders. My home region, Northwest Indiana, has seen a boom on real estate because it's just close enough to Chicago, but they can move just across the border to a tax-friendly state. Illinois, New York, New Jersey, are those state governments going to go after those individuals who move across just for frankly, a ride to work, but a lower tax, bill? How do you see that playing out, and is there an investment opportunity there for real estate?
There is. So if you're surrounding California and people can have a lower tax rate, the writing's on the wall. And the writing's on the wall on the other side too. So first, Northwestern Indiana has picked up 250,000 Illinois residents in the last 5 years. That's a gargantuan number, 250,000. And the property values are going through the roof. There's not nearly a long supply for that reason. Same thing, try to buy a home in Florida. My partner just bought a home in Naples. One of my partners already in Palm Beach. He was all set to buy a house. And in 4 months, the price went up almost $500,000 in 4 months. Clients are flying to Puerto Rico because of their special tax regime. One of my clients was down there last week, said there's no high-end house. They're looking for luxury houses. There's nothing on the market. Everything is goggled up. Prices are going through the roof. People are moving here in droves. So both the Puerto Rico and the United States Virgin Islands have fairly extraordinary tax regimes where you have the possibility of getting a very low tax rate, much lower than you're likely to get anyplace else, particularly for businesses. So people are looking, at that as well. The converse is also true. So Chicago, our real estate has barely gotten back to 2007 levels. If it did, and of 100 major cities in the US, we've had the least appreciation in real estate since the meltdown of 100 major cities. And in 2019, Chicago was the number tourist destination in the United States, beat out New York and San Francisco. Always number one or number two in conventions. In 2020, I'm guessing nobody came here, right? So they've turned it around very quickly. So you don't have demand for the houses. Like a place like Lake Forest, that's it's a good drive from downtown. It's about 35 miles from downtown. And it's a long commute during rush hour. At one point, there was a 7-year supply of houses. Now that all the young people are trying to leave the city and move to the suburbs where it's safe, those home values have ticked back up. But you can buy a 1.5, you can buy a home for 1.5 million. That's a mansion, a 7,000 square foot mansion, 3-car garage and a pool on 2.5 acres. And you can buy a house for $1.5 million. That house was $3.5 million 10 years ago, right? There's such a supply up there. It's a buyer's market. So it tightened up a little with the move out of the cities, but it's still dismal, largely because of this massive exodus out of the state. So I think the real estate play is any of the no tax states have had increases in GDP. The markets are hot. It's absolutely a strong play. Florida, Tennessee, Texas, Incline Village, Lake Tahoe area, Jackson Hole, Wyoming, they're all booming as people are leaving their other states. And amazingly, some of the people who left those states continue to vote the wrong way. And now the states they've gone to are at risk of going the same path that these people just left. So I find that phenomenal. They can't make the connection between these massive tax rates, irresponsible government, and deficits, and putting the same laws back into their new state is just not the best way to make this happen. And I probably got 7 calls from people going, how do I leave the country? Where do I go? Because I just can't deal with it.
People are saying,
Don't California my Texas, don't New York my Florida. Hopefully these economic migrants, political refugees domestically, don't forget why they fled the former regimes. As we look at impact investing and ESG and all this hype about it from the large, institutional investors, are families buying into that, or are they still, black and white P&L focused as they make their investments?
They are buying into it, more so than I would have guessed. If you'd have asked me 10 years if it would be as important today as it is, I would have said no. In a year like last year, where there was really kind of a highlight on the environment and safety and security, equal opportunity, though it wasn't defined as, it's called defined as equality, which is kind of like this egalitarian thing. We all want to be equal, i.e. as in communist equal. I want what you make without working. That's what they mean by equality. I mean equality of opportunity, where if you decide to work, you have the same opportunity I do. If you decide to go home and sit on your butt and do drugs, you have no opportunity as far as I'm concerned. But that's what they mean, the wrong kind in most cases. But yeah, families are really focused on impact investing, particularly as the investment committees are getting people by younger family members. It's a bigger priority, and it's more there because they kind of grew up with it. So it's more on their mind. And increasingly, families are working to align their values with their investment portfolios. An example that was well publicized, I talked to a number of members of the Rockefeller family, and there's hundreds of them, right? They're all just in the Rockefellers are kind of the same family, but they're all over. And the investment committee, driven by the acts of the younger family members, made the decision a few years back to divest from all their oil and gas holdings. So a family that was built by oil and gas has decided we're out of oil and gas. So that's a gargantuan flip and change. And that's more dramatic than most, but many families are paying more attention to those issues. And so I would think that going forward, this trend will escalate. And although they don't want to give up huge returns, it's also being driven because people have realized that one of the problems of philanthropy is that when you give money, it's spent and it's gone, and that's the end of it. Whereas, if you can put it into something that's going to raise the boat for a bunch of people, it's ongoing and sustainable. And so some of that charitable money that would have just gone to a charity or a private foundation is being routed into impact investing kind of businesses. The foundations themselves are investing in impact type investing. And so you've got additional push into that arena above and beyond just the family. So I would say that it will be of increasing importance going forward, and it's relevant already.
Well, that's fantastic insights. I appreciate that. And so this is kind of the part of the show where we ask all of our guests the same set of questions in season 3. It's a lot of yes/no questions, and to the extent you want to put some context around it, feel free to do so. So here we go. Now that there's a vaccine available, would you take it? Yes or no?
My doctor advised me not to, and I'm trusting my doctor.
Second question, 2021, a recession or a recovery?
Very, very modest recovery.
Third question, what's your number one goal for 2021?
To capitalize on the tax and estate feeding frenzy, because I don't know that I will see as busy a year for the rest of my life as we're going to see as a result of all these proposals that are out there. Our families are terrified and they're motivated and pushed into action. The Georgia election put them over the top. And every time somebody talks about a wealth tax and it's your fault and there shouldn't be any billionaires and, why can't you share that all? I'm like, wow, this is a very unique environment. But I think these young people, Antifa and Black Lives Matter, they actually believe this stuff. It's largely a wildly uneducated, unsophisticated group of young people, many of whom, at least in Chicago, I was there at the race riots. I watched this group. There were no protesters. There were mugs and thugs with baseball bats, tire irons, pool cues, jewelry in one hand, stereos on the shoulder, bags filled with goods from Macy's, firebombing cars, attacking people. It was insanity. And their group is, well, we're going to get rid of Western patriarchy. Oh, what a good idea. Because we couldn't possibly have any fewer fathers in Black families. 74 to 78% of these kids grew up with no father. So what? They're 9 times more likely to commit suicide, 18 times more likely to drop out of school, end up in a gang and commit a felony. What could go wrong? It's the absolute opposite of what we need, but these geniuses thought it was okay. Then they went on the radio and said, oh, by the way, it's okay that you rob and pillage and burn these stores down and loot them because they're reparations. You're entitled to it. So they're openly advocating lawlessness. I have zero tolerance for any of that stuff. And the carjacking that's going on, I mean, it's just insanity. I won't go downtown without a firearm again.
Yeah, law and order is critical to economic growth. And I also am a big fan of criminal justice reform because I think there's some things that need to be readdressed because, to your point, I think the nuclear family matters. You need to have dads in houses. What's a big achievement that you've had in your firm in 2020? Like how did your firm kind of prove its resiliency?
I think that the importance of advanced planning and family office structures and being cross-jurisdictional and global for that matter, all elevated in importance to families. We've been camped out there squarely for a long time, so we sort of were in the right place at the right time. I think we're pretty good at calling the ball, and we've been thought leaders for decades. So we're well ahead of where we think the IRS and the agencies are, and we hope to continue to do that. And as a result, with zero advertising, zero marketing, zero PR, and no travel, no entertainment, we typically rack up $20,000 a month in travel. We spent $6,000 for the entire year. I haven't been on a plane since February of last year, and our business went through the roof. Our volume went precipitously up, our costs went precipitously down, and we had a fairly spectacular year. But I don't want to work 3,200 hours a year. It's insanity. So we staffed up a lot, but we couldn't keep up with demand. We still are in the same boat. We're working long hours. We've hired 9 or 10 people last year, and we still cannot keep up with the demand. Like, we're not even close. And everybody in my tax CPAs, tax lawyers, estate lawyers, this is going to go on. It's going to be a spectacular year for those professions.
Yeah, I told our board we hit our budget for 2020, but I don't want to repeat that year ever again. Who's a thought leader in your industry that covers family offices that you look up to, that you think calls the ball right?
I've always been a big fan of the Pitcairns. They have a multifamily office, and they got into alternatives and private equity sort of ahead of the curve, and they've just done a impressive job of doing that. And so in terms of their thought leadership and ability to execute and implement best practices, they've been pretty spectacular, and they've been recognized by the industry. They've won a fairly incredible number of awards. So it's not just me. It's, the law firms, the accounting firms, the consulting firms, the investment banks, the wirehouses, the trust companies have recognized them, which I think they deserve. They're certainly not alone, but they're among the leaders.
What's the last, any books you have for, referral or recommendation that you've been reading?
I'm reading Grant right now, and I love the man. And when Grant statues were being torn down by Black Lives Matter, I was just shaking my head going, you've got to be kidding me. So the guy grew up destitute, was a staunch abolitionist, bought slaves to bring them back to Illinois and freed them, fought the Civil War and won it, and then spent 8 years of his presidency forcing Reconstruction down Southern Democrats who were wearing white hoods and killing blacks, right? So he was incredibly committed. This guy should be a hero to the black community, and they're tearing down his statues. Just idiocy. So I'm reading the Ron Chernow book. He's a meticulous historical researcher, I think is awesome. He wrote Titan. He's written about a number of wealthy families. And Titan's a good read too for people in this space. And then I read a book called Stronghold. So I'm a environmentalist and a staunch fly fisherman. And this guy pretty much spent his life saving Pacific salmon, but fishing at many places that I've been to. And so it was just a really fun read, very well written, very environmental, talks about forming alliances with Russia. When I was over there, like, oh my God, this place is painful. I don't ever plan to go back. Dangerous, corrupt, just a flipping mess. And he described that in the book, which I thought was very entertaining. We fished Kamchatka, pretty spectacular wild rivers there. So really an excellent read. So I'm shifting from the environmental fly fishing book to the history of Grant, which I think is pretty spectacular.
Tom, you bring up a great point about Grant. I mean, what a great American who was not a racist, but the education system in our country is so flawed. And I implore, parents and grandparents, pay attention to what your kids are being told by the teachers, because there's, whether it's foreign adversaries coming in and polluting the minds of the young, or the unions rewriting history, it's pretty crazy what's going on across the country. And that should never happen. Grant was a great American, really ended slavery single-handedly.
All right, well,
just a quick note on that point.
Yeah.
My youngest son teaches in the Chicago Public Schools in a military academy. And these children are not learning history. These are juniors and seniors in high school. He asked 40-some kids, what was D-Day? None could answer the question. And this is a military prep school. They had no idea. Several had seen Saving Private Ryan. They thought it was fiction. They had no idea what D-Day was. Yet they spend a month on nonsense, but they have no background in what actually happened. So when you rewrite history, In fact, there's a teacher at that school that taught her class that Abraham Lincoln owned slaves. I've read 5 or 6 books on Abraham Lincoln. I can assure you he never owned slaves. He was a staunch, vicious abolitionist. He grew up destitute, didn't go to law school, mentored under a lawyer to pass the bar, and spent his whole life fighting slavery. And in fact, the Lincoln-Douglas debates, one of the big issues of that debate, held in Chicago, actually on the site where my current office building is, he was going at Douglas about slavery. Fighting. As a result, he was a Republican candidate that had a sweeping win and ultimately led to him, winning the war and freeing the slaves.
Our last question, are there any podcasts that you listen to besides Non-Beta Alpha?
That's a good question. Not a lot, but I sample a lot. If I see a topic that looks interesting, I think Ben Stein's very entertaining. My sons watch him all the time. There is one. There's a group of New York lawyers who do sort of a quarterly podcast on tax and estate changes. And I know one of them quite well. I don't know the others, but he's very good. And their stuff's quite good. It's the kind of thing that I would ship to my younger attorneys and go, you need to listen to this to understand how this all plays out. I can't think of the name of the group that sponsors it, but it's out of New York City.
I'll ask you to text it to me later, and we'll put it in the comments of the transcript of the podcast. Well, Tom, thanks so much for your insights. I know you're very busy right now, and hope to see you next time I'm in Chicago.
Well, Ryan, thanks so much for having me. It was my pleasure.
Bye-bye.
This show is brought to you by StatusJet. Elevate your status. Fly anywhere, anytime, and experience the difference. Visit statusjet.com to charter your private jet today. Thanks for listening to this episode of Non-Beta Alpha. Don't forget to follow us on Instagram and Twitter, and subscribe on iTunes, Spotify, and YouTube so you never miss a show. While you're at it, if you found value in this show, we'd appreciate a rating on iTunes, or simply share this episode with your friends. And now you know.
All price references and market forecasts correspond to the date of this recording. This podcast should not be copied, distributed, published, or reproduced in whole or in part. The information contained in this podcast does not constitute research or recommendation from Non-Beta Alpha Inc., Wentworth Management Services LLC, or any of their affiliates to the listener. Neither Non-Beta Alpha Inc., Wentworth Management Services LLC, nor any of their affiliates make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, and any liability, therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. The views expressed in this podcast are not necessarily those of Non-Beta Alpha Inc. or Wentworth Management Services LLC, and Non-Beta Alpha Inc. and Wentworth Management Services LLC are not providing any financial, economic, legal, accounting, or tax advice or recommendations in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by Non-Beta Alpha Inc. or Wentworth Management Services LLC to that listener, nor to constitute such person a client of any affiliate of Non-Beta Alpha Inc. or Wentworth Management Services LLC. This does not constitute an offer to buy or sell any security. Investments in security may not be suitable for all investors. An investment of any security may involve risk and the potential loss of your initial investment. Investors should review all risk factors before investing. Investors should perform their own due diligence before considering any investment. Past performance is not indicative of future results. Investment products, insurance, and annuity products are not FDIC insured, not bank guaranteed, not insured by a federal government agency, may lose value.